Hi everyone, Chris Ball here from Hoxton Wealth. Today I want to talk about something that's always important, but especially right now, volatility, and why in times like these, staying the course can make all the difference in your long-term success. The first half of June has brought its fair share of headlines. Markets have wobbled, sectors have moved sharply, but here's the good news. Diversification and patience are still doing their job. They're quietly helping investors weather the noise, and that's exactly what they're designed to do. Let's start with a simple truth. Diversified portfolios are working this year, more so than ever. Despite some big geopolitical shocks and unpredictable market swings, a well-balanced portfolio has remained remarkably resilient. Imagine this, a model portfolio with 30% US large cap, 10% US small caps, 15% international equities, 5% emerging markets and 25% bonds, plus as smaller portions in real estate, commodities and cash. That mix hasn't just survived this year, it's actually outperformed a US only approach, which is something we haven't seen before. Why? Because when one area stumbles, like tech or US equities, others can carry the load. European stocks, for instance, have benefited from lower inflation and easing policy. Commodities have rebounded, especially amid geopolitical unrest. That's diversification in action, and exactly the reason why we like to take a diversified approach with our investments. Now, let's talk about one of the biggest investing pitfalls. You already know this, but it's missing the best days in the market. April the 9th is a perfect example. Markets bounced back big. After Liberation Day, we saw a huge sell-off. Investors who stayed invested saw the S&P 500 part of their portfolio rise by 2.3% year to date. Those who panicked and sold, at the moment, they're ended up 6.6% down year to date. That's nearly a 9% swing from just one decision on one day. And it proves what we always say, time in the market is more important than timing. The biggest gains often happen during the most uncertain times. And it's not just a one-off. Decades of research show this. Most market gains come from just a handful of trading days. If you miss them, your long-term performance suffers badly. Now, let's talk about what's driving the current volatility. On June the 13th, Israel launched their strikes on Iran. Oil surged nearly 9% on fears oversupply through the Strait of Hormuz. Gold rose, Bitcoin climbed, aviation and travel stocks fell sharply. And just one day before that, a tragic air crash hit the headlines in India, knocking airline stocks like Boeing even lower. It had nothing to do with geopolitics, but it shows how quickly sentiment can turn. But here's the takeaway. Despite all of that, markets didn't collapse. In fact, both the S&P 500 and NASDAQ remained up for June. That tells us that while markets are cautious, they're not bracing for disaster. We've seen this before, from the Gulf War to Russia invading Ukraine. Markets have weathered geopolitical shocks. The lesson, don't react emotionally to headlines. Ask yourself, does this change the long-term outlook? If not, stay invested. Now, let's shift to trade and tariffs, our favourite subject. On June the 4th, the US doubled tariffs on steel and aluminium, then came sweeping new tariffs on Chinese imports, up to 55%, targeting even fentanyl-related chemicals. President Trump has also floated auto tariffs over 25%. Markets don't like that, we know. And global exporters and auto stocks sold off fast. But again, this isn't new. It's a return to protectionist policies, something we've seen in various forms before. As investors, we don't control policy shifts, but we can control our exposure. And that's why diversification is so powerful. It spreads risk across geographies and sectors. So you're not overly reliant on one region or one policy trend. Now, let's talk about interest rates and inflation. Rising oil prices have reignited inflation fears in the US. Treasury yields have moved up, which means yes, some bond prices have dipped, but bonds, especially short duration, high quality ones, still play a critical role in reducing volatility and supporting your cash flow needs. And remember, higher yields today mean better returns for income-seeking investors tomorrow. Meanwhile, Europe just made a big move. The ECB cut interest rates, the first major central bank to do so this cycle. The UK may follow with inflation down to 2.3% and a rate cut expected as early as August. The US is taking a slower approach. Jobs are growing, unemployment is steady, wages are rising. So the Fed is holding steady, at least for now. What does this mean for investors? Different economies are moving at different speeds. That's where active management comes in, adjusting portfolios to reflect new risks and new opportunities. So how are we handling this at Hoxton Wealth? We've made a few key adjustments. Reduced US equity exposure, especially in large cap tech. Increased allocation to Europe, where valuations and policy are more supportive. Added exposure to gold and high quality bonds to build resilience. For our clients near retirement, we focused on generating reliable cash flow using more stable assets. For younger clients, we've stayed growth focused, but always with the flexibility to adapt. So let's bring it all together. Volatility may seem unsettling, but it's not the enemy. Emotion is. If your portfolio is diversified, aligned to your goals, and built with care, then the best move right now is simple. Stay the course. As always, if you have questions or just want to chat through your plan, reach out to your advisor or email us at client.services@hoxtonwealth.com. We're here to help you stay informed, stay confident, and stay on track. Thanks for watching. Have a great day ahead.